Yes, friends, welcome back. This time we are back with one of the important topics of your syllabus, standard costing. We all know that this topic is important, and trust me, I don't know what is your opinion, but you can actually score 100 out of 100 in this. I mean, full marks out of, if it comes for 20, you can score 20. If it comes for 10, you can score 10. Provided you follow certain things. Point number 1, do not go for formulas. Apply your logic and get the answer. Do not follow formulas unnecessarily, because you cannot by heart so many formulas at a time and implement them. So rule number 1, do not go formula wise. Apply your mind, apply the logic and get the answer. You can of course write formulas as a formality later, so that examiner will not get any chance to deduct your marks. But your formulas should be the end of the solution, not the beginning of the solution. That is your rule number 1. Rule number 2, never forget rule number 1. Never go for formulas. Trust me, guys. Now, standard costing is basically a cost control device, and it is basically used to control the cost structure. Now, you know there are two parties. One is owner and the other one is manager. Owners don't manage the business and managers are not owners of the business. Funds of owners will be required to be managed or utilized by managers, but since they are using someone else's money, it's a human tendency. More than management, there will be a mismanagement. More than utilization, there can be a misutilization. So how to avoid how to avoid that misutilization part? Standard costing is a device which is used, standard costing is a technique which is used to control the cost structure, and when you do that, kindly remember, some standard is set by the owner in the beginning of the year, and the standard is followed by the managers throughout the year. On a regular basis, actual cost is determined, and it is on a regular basis compared with the standard. Every time it is determined, because when you compare your actual with the standard, you realize whether there is any variation, whether there is any deviation. And if there is a deviation, you need to analyze the deviation. You need to find out the reason for the deviation. That is what we do in case of standard costing. For us, finding out variances is the important part. Analysis of variance is not there in our syllabus. It's at final CA level, not at inter level. So calculation of variance is the only thing which we are supposed to do as far as CA inter standard costing is concerned. Now, your business is basically dependent on 3 things: sales, cost and profit. And trust me, each one can give you a variance. Now, whenever you compare actual with standard, and if there is a variation, which I'm sure there will be, the variation, the difference between standard and actual is called as a variance. Variation gives you variance, and the variance, either it will be good for us or it will be bad for us. If it increases our profit, it is going to be a favorable variance, and if it decreases our profit, it is going to be an adverse variance. If it is going to increase the profit, it is favorable variance. If it is going to decrease the profit, it is going to be an adverse variance. Never decide adverse favorable based on signs. Minus is adverse, positive, plus is favorable. No, please don't go by that. You will again land up in a big trouble. Find out the impact on profit. If the impact is negative, If your profit is going down, it is an adverse variance. If your profit is going up because of that, it is a favorable variance. Kindly make this part, keep this part very clear with you. Is that part clear? Mind blowing. Now, when I talk about cost, there are three types of cost. Material, labor, overheads. Oh yeah, and when I talk about overheads, there are two types, variable and fixed. I hope you're relaxed now. Why the fourth line was drawn? It was for this. I hope this is clear now. So there are four different types of cost structures which we are supposed to deal with. Material cost, labor cost, variable overhead cost variances are one segment, I would say, because all three are variable in nature. All three will go up and down with the increase and decrease in the quantity structure. All three will go up and down with increase and decrease in the quantity structure. So the variance calculation is almost the same. Fixed cost calculation, fixed cost variance calculation is totally different because the concept is different. Then we can also have sales variances as well as profit variances. Profit variances are not generally expected at CA interlabel, but you never know. We have done one question based on profit variance also to cover up the profit variance part. So now, how do we work? See, like for example, the standard is set to be 10. The cost should be 10. If the cost is 11, answer is -1, but it is not -1, it is 1 adverse because my cost is going up, profit is going down. I expected cost to be 10, but the cost is 8. Oh my God, it is 2. Cost is going down, profit will definitely increase. It's a favorable variance. But guys, if it was a selling price, your whole calculation would have been different. Had it been selling price, your calculation would have been different. Selling price should have been 10. I should have sold my product for 10, but I sold my product for 11. Answer is still -1, but this time it is favorable because you have sold product at more than what you were thinking of. Instead of getting profit of 10 rupees per unit, you are getting profit of only 8 rupees per unit. Your profit is going down, so it is an adverse variance. Guys and girls, please understand one thing. Don't go by positive, negative. I proved it. Plus minus will always be deceptive. If it is increasing profit, take it as a favorable variance. If it is decreasing profit, take it as an adverse variance. Do not go for plus minus. That is the first thing. Now, what do we do in case of the first variance? Let's go one by one. We had the first category, total material cost variance is the first one, which gives you overall impact of material. Then we have material cost variance. Split into two parts. One is price and the second one is quantity. And quantity is split into two parts, mix and yield. So, material cost variance is the overall effect split into two parts. Material cost variance split into two parts. Material price variance, material usage variance, material mix variance, material yield variance. Material mix variance, material yield variance. How do we go about it? See, cost variance is the overall variance. How much should have been my total material cost and how much is my actual material cost? I'm going to compare these two. I'm going to get the cost variance. If I'm spending more on material, it's going to be adverse variance. If I'm going to spend less, it's going to be a favorable variance. If it is going to be more, it is going to be adverse variance. If it is going to be less, it is going to be a favorable variance. We need to find out reasons for all variances. Always remember one thing. The objective is not finding out only cost variance and sit idle. If you are spending more or spending less, you should be knowing the reason for that. So, before we go for the further analysis, one very important point I need to tell you. You will be having standard data given in the question at one level, and you will be having actual data given at one level. If you are calculating variances, remember one thing, these two data must be at par. If you are going for standard data and actual data, if you are going for standard data and actual data, if you are comparing actual data with the standard data, trust me, the comparison has to be at cost. The comparison has to be at par. So, if standard data is given for 1 unit, but if your actual output is 5,000 units, your standard data, if it is given for 1 unit and if your actual output is 5,000 units, revise your standard from 1 unit and take it to the level of 5,000 units, because actual data can be changed, but standard can be revised. Standard for 1 unit and standard for 5,000 units is one and the same. It is just that the level is increased from 1 level to 5,000 level. That's it. It's not going to be a different standard set. The standard remains same. The standard remains same. But the level of standard changes. And I am taking it to the level of actual output, so that my actual data is already at 5,000. Now my revised standard is also at 5,000. I know how much I should have incurred. I know how much I have incurred. I can get the variance calculation done. If my standard is given for 50 units, if my actual output is, if my standard is given for 5,000 units and if my actual output is 50 units, I will convert standard of 5,000 and I'll bring it down to the level of 50, because my actual output is 50. So guys, please understand one thing. Your actual data must be compared with the standard data at a common level of actual output. At a common level of actual output, and for that we need to revise the standard from whichever level it is, and we have to take it to the level of actual output. This is your standard costing. Is that part clear? Okay. Let us have brief discussion on question number 2, so that your material variances part can be revised. In question number 2, we were told that in order to produce 100 kgs in a batch, in order to produce 100 kgs per batch, you need to input 125. So your standard input was 125. Your standard input was 125 for producing 100 units. But the team actually managed to produce 5,600 kgs. Okay, so for 100 kgs, I was supposed to input 125. I have actually produced 5,600 kgs. So my standard input was calculated by way of a cross multiplication. For 100 kgs of production, I need 125. How much do I need for producing 5,600? How much do I need for producing 5,600? And that gives me this part. And that gives me this part. I've got 7,000 as an answer. Cross multiplication, it was that simple. I was also told that standard input will be split in the ratio 50, 30, 20%. Okay, so my standard input of 7,000 was split as 50%, 30%, 20% to give me these three figures. To give me these three figures. Now, you may find a little different solution. I mean, the answer is not different, the columns are different, that's it. But the ultimate concept is still the same. Okay, methods, presentation can be different, but the final answer is the same. I applied a standard price here to get the standard cost structure, and I realized that in order to produce 5,600 kgs, my cost should be 98,000. Now, they did not give us actual information. But they did not even tell us that actual input was different. So it was pretty simple. My one batch of 100 kgs, when it is produced, my input is 125 kgs per batch. My input is 125 kgs per batch. When I produce 100 kgs, my input should be 125 kgs. So if I'm executing 60 batches as per the instruction in the question, 60 batches into 125, 60 batches into 125, 7,500 must have been actual input. See, they did not tell us that actual input per batch was different. They did not tell us. So 125 kgs should have been input of each batch. 60 batches will definitely have an input of 7,500 kgs. They also told us the combination of actual input to be 60, 20, 20. 60, 20, 20. So we got this answer. We got it done. Is this part clear, guys? Yes. So 7,500 was split in the ratio 60, 20, 20 to get this quantity multiplied by the given price. I realized that I should have incurred 98,000, but I have actually incurred 1,15,500 to produce the same production, and that is why I'm getting an adverse variance of 17,500. 98,000 I should have incurred, 1,15,500 I have incurred 17,500 more. If I have incurred more for producing the same output, it is definitely an adverse variance. Now, as I said, your cost variance, when it happens, there are two reasons. One is price, which is a responsibility of purchase manager. Price variation says I should have purchased at 20, but I paid 21. 1 rupee I paid more on 4,500 kgs. So that's my adverse variance. Instead of 10, I spent only 8. So I saved 2 rupees here. I saved 2 rupees on 1,500. So that's my 3,000 favorable. And instead of 5, I spent 6 rupees for purchasing the material. 1 rupee I paid more on 1,500. 1 rupee I paid more on 1,500. That's my adverse variance. Okay, so 4,500 adverse, 1,500 adverse, 6,000 adverse, 3,000 favorable. So net effect is 3,000 favorable for me, which is my price variance. That is a responsibility of my production manager. Is responsible for quantity variance. My production manager is responsible for quantity variance. I should have consumed this. I have consumed this. If I have consumed more, it is adverse variance. If I have consumed less, it is favorable variance, because if I am consuming more for producing the same output, I am wasting the material. Now listen, since usage variance is a responsibility of production manager, since usage variance, quantity variance is a responsibility of production manager, do not consider actual price in any of the calculations, because actual price is a responsibility of purchase manager and not production manager, guys. Actual price is not a responsibility of production manager. It is a responsibility of purchase manager. We are currently calculating sole pure responsibility of production manager. So I'm not supposed to take actual price into consideration. So whole quantity variation, whether adverse or favorable, is multiplied by standard price. Is this part absolutely clear? So standard quantity minus actual quantity into standard price is the answer. Quantity variation will be multiplied by standard price, because actual price cannot be applied, as it is a responsibility of as it is a responsibility of production manager. We cannot take actual price while calculating responsibility of production manager. I hope this part is absolutely clear. Now, we might have got this 17,500 adverse, 3,000 adverse, naturally this is 14,500 adverse, and that tallies. But then I always need to find out the root level cause. I want to know the ultimate reason for getting these variances. I'm not happy only with price and usage. So when I try finding out reasons for these subvariances, I realize that price variance cannot have another further evaluation because that was a price prevailing in the market. So there is no further evaluation required. But usage of quantity usage was your in-house activity. You should have a control over it. Quantity was your in-house activity. You should have control over it. You should have control over it. How will you go about it? You will have to evaluate quantity variance further. Listen, if you are producing more by consuming less, if you are producing less by consuming more, in any scenario, you need to know the reason. Guys, always remember one thing, whether the variance is adverse or favorable, in both cases, it needs to be evaluated. Like if I take 110 hours instead of 100 to complete one batch, I will be questioned. Agreed. If I take 90 hours instead of 100, I will still be questioned even if there is a favorable variance, because I may sacrifice the quality. I may sacrifice the quality to get things done. I may sacrifice the quality to get things done, which is wrong, which is absolutely wrong. Is this part clear? So, whether it is a favorable variance or it is an adverse variance, I need to verify. I need to find out the reason for both. So, when I started finding out the reason, I realized that 7,500 was the input, and that input as per standard requirement should have been in the ratio 50-30-20. That means when I input 7,500, I'm okay with 7,500 being input, but that should have been in the ratio of 50-30-20. That means my quantity should have been actually 3750, 2250 and 1500. Correct? But it is actually something else. So revised minus actual will give you mixed variance. Mixed variance is very important, guys, because if your costlier material, if your costly material having a higher selling price, if your material having a higher selling price, if your material having a higher selling price, is consumed more, and if cheaper material is saved, you will never see that saving impact in your whole calculation. A costly material, if consumed more, if quantity of costly material is consumed more, you perhaps will never be able to even realize what is the impact created by the cheaper material by putting less quantity of cheaper material. So I need to evaluate the combination, guys. The quantity should have been 3750, 2250 and 1500, but it is something else. You are consuming more in case of A, So it's an adverse variance. You're consuming less in terms of B. Look at the difference. 750 kgs consume more in case of A. 750 kgs only got saved in case of B. Guys, 750 in case of A got consumed more, adverse. 750 kgs got saved in case of B, favorable. So ideally the impact should be nil, no? Because in case of C, 1500 you should have input, 1500 you have input, so there is no variation. In case of A, you consume 750 more. In case of B, you consume 750 less. In case of A, you consume 750 more. In case of B, you consume 750 less. So ideally, the impact should be nil. But your material A is the costly material. So costly material was consumed more. So look at the adverse variance. The impact of adverse variance is applied to the entire variance. It is spread over the entire variance. 15,000 adverse is your adverse variance in case of A, and 7,500 only is your favorable variance in case of B. I told you, the costly material, if it is consumed more, you will never see the impact of cheaper material, even if it is saved. This is what I meant. I hope you understood this part. And then finally, the input-output ratio evaluation. I should have consumed 7,000 to produce 5,600. I should have consumed 7,000 to produce 5,600. I consumed 7,500. I should have consumed 7,000, but I have consumed 7,500. $500 kgs were input extra, but there was no extra output produced. So whatever I was supposed to produce by consuming 7,000, I produced the same thing by producing 7,500. That means my input-output ratio is wrong somewhere. This 500 kgs of extra input should have given me more than 5,600 kgs of output. It didn't. And I can see the entire 500 kgs getting converted into wastage. Our wastage was expected to be 1,400. But actually it is 1,900. So whatever extra input of 500 kgs was made, the entire input of 500 kgs got converted into wastage and not finished goods. That is adverse. I wanted standard price to be applied, but since I am not going for ABC breakup, I am going for 7,000 minus 7,500. I am going for 7,000 minus 7,500 as my input variation. So if I am not going for ABC, I would like to go for weighted average standard price 98,000 divided by 7,000 to give me the yield variance. Yield variance is your input-output ratio evaluation. 500 kgs were consumed more but couldn't give me finished product. Okay. So multiplied by the standard weighted average standard price which was applied here. So that was material variances, guys, for you. Question number 2. Certainly important questions. Of course, on the basis of purchase also you can find out variances. On the basis of purchase also you can find out variances, but that exists in single plan, partial plan, single plan concept to be more precise, which is at final CA level. Don't, institute has not mentioned that in your study material, but still, if at all, if I want to go for purchase, my purchase will look like this. Of course, that will also change your cost variance. It's a different concept altogether. We'll discuss that at final CA level. But this can also be the calculation of price variance where you don't consider actual quantity consumed, you consider actual quantity purchased. So your cost variance will change and your price variance will be different. Rest other variance will remain same because the other variances are not going to get affected. So your cost and price are the only two variances which will be affected. This is single plan calculation which is at final CA level. Let's not discuss more because it is not mentioned in your study material. So that was your material variances, guys. Now I would like to discuss with you basic labor variances. Labor variances can be calculated in different ways. First one is cost variance followed by rate and time variance, which is also known as efficiency variance, which is split into two parts, mix variance and yield variance. Exactly similar to material variances. But if there is an idle time, please understand, if there is an idle time, your time variance and efficiency variance cannot be the same. Please try to understand this. If there is a time variance, if there is idle time given, abnormal idle time, which is part of actual hours, you have to consider time variance first, which will be split into two parts, idle time and efficiency. Please mark this thing very clearly. Whenever you evaluate efficiency of workers, you cannot consider idle time as a part of calculation. So you consider this as efficiency since it includes idle time. So from time variance, you separate idle time and calculate your efficiency variance based on standard hours minus hours worked, actual net hours, after deducting idle time from your total actual hours. Are you getting me? So once you separate idle time, efficiency variance will have two parts, mix variance and yield variance. There is one more calculation which is available. This can also be done. Cost variance split into two parts, rate variance and time variance. Time variance can be split into two parts, labor idle time variance, labor mix variance and labor yield or efficiency variance. But then see, there is no cost accounting standard that governs standard costing technique. Okay, so you can calculate by any method. Module is going for this one. Whatever you can see on my head is what they are doing. Rate variance, time variance. Of course, sometimes they don't even calculate time variance. What they do is labor cost variance, three parts, labor rate, labor idle time, labor efficiency. It's one and the same, and efficiency is split into two parts. This is what they have followed in the study material. We have also done that. I calculate time variance also because that gives you clarity about how much is the excess payment for excess number of hours and how much is the payment saved in terms of saving in terms of hours. So cost variance, rate variance, time variance. Time variance is split into two parts. Idle time will be separated from efficiency. So this is standard hours minus actual hours, but this is standard hours minus actual net hours because idle time is already separated. Your revised hours calculation, your mix variance, yield variance, everything will be based on net hours. Everything will be based on net hours. That is only when there is an idle time. And whenever there is an actual idle time, abnormal idle time, do not separate that in the table. If I talk about question number 4, first of all, I was having number of units with me. And I knew number of units means number of workers, basically numbers with me. 32 workers. Now I'm not going to put workers inside the machine. So there was 40 hours work done during the week. Each worker will work for 40 hours. So 32 will be working for 40 hours. 12 will be working for 40 hours, 6 will be working for 40 hours. 32 workers will work for 40 hours, 12 workers will work for 40 hours, 6 workers will be working for 40 hours. And when I do this, trust me guys, when I do this, I get total number of hours like this. 1280, 480, 240. So that means the standard is given for, the standard was rather given for 2000 units. Then we realize that we have actually produced output of 1800 hours. Now, how can someone produce hours as an output? See, instead of giving you information in terms of units, they may give you information in terms of hours. Like for example, if one unit should take 1 hour. Standard hour requirement is 1 hour for 1 unit. And if I am producing 1800 units, rather than telling you that I have produced 1800 units, I will tell you that I have produced 1800 standard hours. If I produce 3600 units, I'll tell you I have produced 3600 hours. Okay, 1 hour produces 2 units. In 1 hour, I should be producing 2 units. So if I produce 3600 units, I should have done that in 1800 hours. So instead of telling you that actual output is 3600 units, I'll tell you my actual output is 1800 standard hours. So don't bother much about this. Simply replace hours by units. 2000 was the standard output. 1800 was the actual output, which was 90%. So whole thing was converted into 90%. Simple it was. The data was available for 2000. I was producing 1800. Okay, so 90% it is. So the standard is also converted at 90%. And we also found out actual hours based on that. Now, if there is no idle time or there is idle time, doesn't matter. Your table will remain like this. Idle time will be separated later. Once you calculate time variance, you separate idle time, not before that. So a table will remain like this. And then you calculate your required variances based on this. If I talk about question number 3, same thing. Standard was given for 1 unit. Actual output was 5000 units. So as usual, we converted standard of 1 and we revised it and we took it to the level of, and we revised it and we took it to the level of 5000. There was an idle time, but we did not consider idle time in this calculation. There was abnormal idle time, which we did not consider in the calculation. And finally, we have got this data. On the basis of this, we calculated 3 variances. After that, we separated idle time. We calculated idle time variance. Idle time variance was calculated. Thereafter, my efficiency variance calculation was based on actual net hours. Since I have already separated idle time, mix and yield will be an outcome of actual hours, which are net hours, which are hours worked. Remember one thing, you cannot calculate efficiency variance inclusive of idle time. You cannot calculate efficiency variance inclusive of idle time. You take your own example, you are a worker, you have worked for 10 hours in a day. I am supposed to pay you for 10 hours. Now due to power failure, 2 hours you couldn't work. Guys, you were there in the factory for 10 hours, I have to pay you for 10 hours. Due to idle time, due to power failure, you couldn't work for 2 hours. That means you have worked only for 8 hours. And in 8 hours, you actually completed work of 9 hours. You could work only for 8 hours. 2 hours you were ready to work, but I couldn't give you the work because of power failure. So ideally, you worked for only 8 hours. But in 8 hours, you completed production of 9 hours. Are you efficient? Of course, yes. Of course, yes. Because whatever you were supposed to be done in 9 hours is done in 8 hours. You have saved my 1 hour. But why are you paying for 10? The team was working for 10 hours. Idle time is not a responsibility of workers, so they will be paid for hours idle time as well. But I cannot calculate your efficiency on the basis of 10 hours because 10 hours include 2 hours idle time, which is not your responsibility. So efficiency variance, no matter what is it, efficiency variance will always be on the basis of net hours after separating idle time. Your efficiency variance should not include idle time calculation. You have done that in fixed overhead variances also. You have done that in variable overhead variances also. So why special treatment for labor? No, there is no special treatment for labor. Efficiency variance will always be exclusive without considering idle time after deducting idle time from the actual hours. Actual abnormal idle hours will not be considered for efficiency variance. So get time, split that into two parts, idle time, efficiency. Efficiency will be standard hours minus actual net hours worked, and mixed variance and yield variance will also be based on net hours. Revised hours will also be calculated based on net hours. Then this was a reverse question. There is nothing to be discussed. It was pretty simple. I have always told you. Reverse question is nothing but the data which is normally given will be missing, and the data which is normally not given, the data which is normally calculated will be given. So they did not give us rate and standard hours which they normally give us. That is why they gave us rate variance and efficiency ratio. So we applied those efficiency ratio, and we got these answers. Question number 6 was little important. Your answers were in decimals. Whenever you have kgs, hours, please take answer up to 2, 3, 4 decimals. It's okay if you want to take hours and kgs in terms of decimals. It's fine. At least it will give you an accurate answer. Amount you can round it off. Not an issue. See what I have done. See, my standard data was given for 1260 kgs. How? They said 800 should be A, 600 should be B, that means total should be 1400, and 10% should be the loss. So 1400 minus 10%, 1260 should be the output. So the standard data is given for 1260, but actual output is 1480. So we applied the cross multiplication technique to get the answer. 1260 consists of 800, how much in 1480? 1260 consists of 600 kgs of B, how much in 1480? We got this answer. Since it was in decimals, I did not round it off because that would be giving you a different answer. Amount I rounded off, and after this we calculated 5 variances in a very normal manner. For labor, they said there is an idle time of 5% which is expected. Now it is an expected idle time. That means you already know that out of 1000 hours, 5%, that means 50 hours the team is not going to work for. Out of 800 hours, 5%, that is 40 hours the team is not going to work for. So out of 1000 hours, 50 will be lost. Out of 800 hours, 40 will be lost. So when you already know that, that will get reflected in the table. Again, this was for 1260 kgs. 1260 kgs if I want to manufacture. 1260 kgs if I want to manufacture. Skilled should work for 950 and unskilled should work for 760. So cross multiplication gives me the answer. How much for 1480? Correct? So we wrote those number of hours and we got this answer calculated. So what was a different point in this? Take quantity structure in decimals to get an accurate answer. That is point number 1. Secondly, whenever there is a normal idle time, expected idle time, it will never be forming part of actual then. Actual hours, if they include idle time, that is abnormal idle time, that is unexpected. If it is unexpected, you can't help it. You have to pay your workers for that. But when you already know that they are not going to work, it is to be subtracted and net hours to be taken into consideration forever. Right from the beginning, you remove the expected idle time and solve it. This is what the ICI has done. And after this, we got variances calculated. Variance part is quite simple, you know that. Variance part is not a big deal. So, in case of labor, let me explain this. If your actual rate is more, it's an adverse variance. If your actual rate is less, it's a favorable variance, and this is the responsibility of HR manager. For time and efficiency variance, it's a worker's responsibility, and since it is worker's responsibility, it is better to split idle time, separate it and separate its impact from the calculation. So if actual hours are more, it's an adverse variance. If actual hours are less, it is a favorable variance. Revised hours minus actual net hours will give you mixed variance, and this is my overall impact. Overall impact says this. Whatever we were supposed to do, 50,000 hours, I cannot take 56, because out of 56,000, question has clearly told us that 1,000 is idle time. Out of 56,000, question has already told us that 1,000 is idle time. So 56,000 minus 1,000, 55,000 hours. 55,000 hours the team has actually taken. So whatever they were supposed to produce in 50,000 hours, they actually got produced in 55,000 hours, which has given you the yield variance. So again, that is about input output. That was about your labor variances, guys. You follow any formula, that's fine, but then whatever we have discussed, time, two parts, efficiency and idle time, and efficiency is further subdivided into mix and yield. That is being followed everywhere and even by the ICI. So it's the same thing to be followed, not an issue. But yes, if you are calculating efficiency variance, any efficiency variance will always be exclusive of idle time. Idle time just cannot be included in actual hours if you are going for efficiency evaluation. Is that clear? Okay, let's get continued with the most important, fixed overhead variances. Yes guys, now as far as fixed overhead variances are concerned, please try to understand one very important point here. For material variances, for labor variances and for variable overhead variances, variance calculation has to be done at par. And at par means at the level of actual output. At par means at the level of actual output. Whenever it comes to material, labor and variable overheads, all three were variable cost structures. So output was the base, because variable cost gets affected because of change in the output. But now we are dealing with fixed overhead variances. Let me tell you one thing, fixed overhead doesn't get affected with the change in the quantity. Fixed overhead doesn't get affected with the variation in the quantity. So quantity output is not a base for calculating variances. Your fixed cost is a period cost, isn't it? Your fixed cost is a period cost, so period should be constant. So if your standard data is given for 3 months and actual data is given for 1 month, please convert your standard from 3 months to 1 month and then start calculating variances. So standard data, budgeted data and actual data both must be for the same period. And the period should be the actual period, not the standard one. The period must be the actual period and not the standard one. So if my standard is given for 1 month, actual is given for 1 year, this will also be converted into 1 year by multiplying everything by 12. So actual period is to be considered as a base, never forget that. Now as far as fixed overhead is concerned, I'll just give you a shortcut. You need 8 items. You need 8 items like this. Budgeted fixed overheads, actual fixed overheads, budgeted output, actual output, budgeted hours, actual hours, budgeted days, actual days. Please split your answer like this. It doesn't matter what is given in the question. I am not concerned with that. You try to extract this information from the question. You try to extract this information from the question. There is nothing else you are supposed to do. You are not supposed to do anything else. Just get this done. Once you do this, budgeted fixed overheads upon budgeted output will give you per unit absorption rate. Budgeted overheads upon budgeted hours will give you absorption rate per hour. And budgeted overheads upon budgeted days will give you absorption rate per day. Of course, per hour and per day, we don't need that initially. We need them directly in some specific variance calculation. But it's always better to get them calculated together as a first step. So 8 items you find out from the question, no matter how clean and clear the question is, no matter how cluttered the question is, search for these 8 items, get 3 absorption rates. Now, your fixed overhead is always absorbed on the basis of output whenever you are producing one type of product. So, per unit absorption rate, like here, my absorption rate was 20 rupees per unit. I decided 50,000 will be my cost. 2,500 units I'm supposed to produce and sell to recover that cost. 50,000 I'm supposed to produce and sell to recover that cost. If I have 2,500 units to recover that cost, that means each unit must give me 20 rupees back. But I have actually produced 2,550 units. 50,000 I was supposed to recover. 2,500 is going to be the quantity. 20 rupees per unit I was supposed to recover. 20, 20, 20, 20, 20, 20, 20, 20 will give me 50,000 back. So that's what my plan was. But I actually managed to produce 2550. So 2550 into 20, 51,000. 51,000 is the amount that is recovered by you. So you absorb 51, against that you incurred 53. Guys, if you have incurred 53, you should have absorbed, you should have recovered 53, but you could absorb only 51. 2,000 you couldn't absorb, and that was your absorption rate. That was your first variance, fixed overhead cost variance. Basically, it was under absorption. And there are 2 reasons for that. Budget going right wrong. See, basically under absorption, if it happens, it's mainly because of the absorption rate. Absorption rate is an outcome of 2 things: budgeted fixed overheads upon budgeted output. In my case, my budget went up. My actual expenditure was more than the budgeted. So 3,000 adverse is my budget variance, expenditure variance. So my budget went wrong to the extent of 3,000. Still my overall loss is only 2,000 because here I produced 50 units extra. I thought of producing 2,500 units, but I actually managed to produce and sell 2,550 units. 50 units I wanted to produce extra. 50 units I produced extra. Each unit started giving me 20, 20, 20, 20, 20, 20, 20, 20, 20, 20, 20, 20 towards fixed cost. 50 extra units suddenly produced, 20 from each unit recovered. Suddenly I've got a revenue of 1,000. Oh, so my budget went wrong to the extent of 3,000. But I recovered 1,000 rupees more by selling 50 extra units. So budget variance is 3,000 adverse. Volume variance is 1,000 favorable. Volume variance is 1,000 favorable. My net variance is 2,000 adverse. These are my first variances. These are my basic 3 variances first of all. Is this part absolutely clear? Or is it done? Okay. Now, as you know, we always try to find out root level reasons. Now, budget going right wrong is not a big deal here, but budget is an estimation. It is bound to be different from actual. What you think, what you estimate. Estimation can't be accurate. So whatever you actually incur will always be different from whatever you estimate. That's fine. That is pretty simple. That is simple. Not a big deal as such. But I would say volume was your in-house activity. If you are producing 2,500 and you thought of producing 2,500, you plan to produce 2,500, you estimated 2,500 units to be produced, and suddenly you are producing 2,550, boss, you should be knowing the reason. But sir, why there is a need of doing this? You are getting 50 units extra, no? So enjoy. It's not about enjoyment, guys. If I find out that instead of 2,500, I can easily produce 2,550, Why should I give a standard of 2500 to my workers? I will give them standard of 2550 and try to produce more, no? I hope you are understanding this. 100 hours were given to me to complete the batch. Easily I could complete it in 95 hours. I proved it right. I use some technique whereby it can be done in 95 hours. Then why should they give me 100 hours? Think from the company's perspective. Mayuresh can complete the syllabus in 95 hours. Why should they give us the standard of 100 hours in first place? The standard will also be revised down to 95 hours, no? I hope you are understanding this, right? Yes. So I need to evaluate number of units which are produced more. I need to find out the timing. I need to find out the reason. I need to find out the cause behind it. My first reason is, of course, a number of days utilization. Now please be clear about one thing. My first variance, my first subvariance of volume variance, my first reason for volume variance is calendar variance. And calendar variance talks about excess utilization in terms of days. Instead of utilizing 25 days, I utilize 27 days. Guys, your fixed cost is a period cost. Once it is incurred, it will be incurred in the next period. So if it is a per month rent, it will be incurred in the next month, irrespective of how many days you are working in the current month. You thought of working for 25 days, you work for more than 25 days, that doesn't matter to the landlord. No, he will be charging you for 1 month. So unless you cross 1 month, he is not bothered. You understood this? So whatever you have paid under an assumption that you will be working for 25 days, you will be working for 25 days, you have actually worked for 27 days. You have worked for 25 days, you have actually worked for 27 days, but you thought of working for 25 days. That means there was an excess utilization of 2 more days, and of course it was without paying any extra fixed cost, right? So excess utilization without paying any extra fixed cost is definitely a good sign. Instead of working for 25 days, I am working for 27 days, 2 more days worked in the same premises without incurring any extra cost. Can I see the reason? Yes, you can. 50 extra units were produced. So 2 extra days, but I don't want to answer in terms of days. I want to answer in terms of rupees. So per day charge is applied on 2 days. Per day charge is applied on 2 days. It's a favorable variance of 2000 even if it is negative. Even if it is negative. 25 minus 27 into 2000. Calendar variance. If it is negative, it is favorable because it is excess utilization without any extra fixed cost. Now in 25 days, you were supposed to work for, in 25 days, you were supposed to work for 5,000 hours. In 25 days, you were supposed to work for 5,000 hours. In 27 days, you should have worked for 5,400. Boss, you should have utilized your premises for 5,400. You are utilizing that premises for 5,500. 100 hours excess utilization. 100 hours excess utilization. Hundred hours excess utilization without paying any extra fixed cost is also favorable. So 100 hours into hourly rate 10. One very important factor, even if your calendar variance and capacity variance are negative, they are still favorable because it is excess utilization without incurring any extra fixed cost, guys. Secondly, why I did not skip idle time from this. See, even if there is an idle time, premises are utilized. If you are having a lunch, you will have lunch in the premises itself, even if there is no power failure, even if there is no power, even if there is no power supply, if there is no material issued to you, if you are out of stock, fine, whatever it is, but premises are still used, no? Factory only. Workers will be sitting inside factory only. You don't throw the worker out or you don't dismantle your machines. Premises are utilized. Workers were there. They couldn't work. So that I'll find out later. But whether it was utilized or not, yes, it was utilized. Workers were there for 2 extra days and workers were there for 100 hours extra, even if it was an idle time. I don't care. So in that case, in that case, idle time is not to be separated. So, 2 points, idle time should not be separated, that is one, and even if your answer is negative, it is still considered as a favorable variance because it is excess utilization without incurring any extra fixed cost. For God's sake, for heaven's sake, don't consider efficiency here. It's not 25 days work was done in 27 days. No. Instead of 25 days, I utilized 27 days, but we did not pay anything extra. Instead of 5,400 hours, we got to utilize the premises for 5,500 hours. We did not pay anything extra. So it is excess utilization without incurring any extra fixed cost. That is why calendar variance and capacity variance are to be treated as favorable variances even if the answer is negative. Now, my calendar variance is 4,000 favorable, capacity variance is 1,000 favorable, the total is 5,000 favorable, but my volume variance is only 1,000 favorable. So 5,000 favorable is going down to 1,000 favorable, that means there is 4,000 adverse waiting for you. Definitely that has to be because of inefficiency. Guys, 2 more days you worked, 100 hours extra you utilized, still you are producing only 50 extra units. That means you did not use the time properly. That means there is something wrong with your efficiency. And again, whenever you try to evaluate efficiency of your workers, guys, whenever you try to evaluate efficiency of your workers, please separate idle time. So that's what we did. We separated 200 hours idle time multiplied by hourly rate, 2000 hours, 2000 adverse, and finally we went for efficiency. Now for efficiency, the calculation is very simple. I always prefer getting these two answers. When 2500 units were supposed to be produced in 5000 hours, my actual production of 2550 should have been done in 5100 hours. So the work of 5100 hours was actually completed in 5300 hours. 200 hours were taken more. 200 hours were taken more. It's a 2000 adverse variance. In other words, 5000 hours we decided to work. That's what my budgeted time is. 2500 units I was supposed to produce in that. But if I work for only 5300 hours, or if I work for 5300 hours instead of 5000, definitely I should have produced more, 2650. Instead of 2650, see, the time indicates that I should have actually produced 2650. My time indicates that I should have produced 2650, but I have actually produced only 2550. 100 units I couldn't produce. Just imagine if I would have produced 100 units, if I would have worked efficiently, if I would have utilized the time properly, I could have produced 100 units more, and those 100 units would have given me 2000. So by not producing 100 units, I lost an opportunity. Of recovering 2000 from the market. So you can see this efficiency calculation, and you can copy this if you want by pausing this video. One is based on hours, the other one is based on output. The one is based on hours, the other one is based on output. You can see the solution here. My first part is 8 items, 3 absorption rates, 1 fixed overhead absorbed. This is a common factor. If they don't give you information about number of days, guys, there won't be a calendar variance. So first you find this out. Okay guys, if you want to copy this, you can copy this by pausing this video. This is what we need. Then my first 3 variances, copy first 3 variances or take a screenshot. First 3 variances in a normal manner. Correct. Then my next 3 variances, calendar capacity, idle time, excess days utilized, excess hours utilized without incurring any extra fixed cost. So favorable 4 and 5 are about utilization. But then I realize the total would have been 5000, but the 5000 has gone down to 1000. That means 4000 adverse is the variance waiting for us. Out of that, 2000 is due to idle time, which is not customer's responsibility. So customer's responsibility, which is not worker's responsibility. So workers are responsible for this. and formulas were generated later. These are standard hours for 2500 units, 550 units, so standard hours for actual output. This is standard output in actual net hours. So don't by heart formulas, otherwise you'll get confused with this. In 2500, for 2500 units, 5000 hours should have been taken. For 2550, 5100 hours should have been taken, cross multiplication. In 5000 hours, I should have produced 2500 units. In 5300 hours, I should have produced 2650 units. Compare that with the actual one. You will come to know whether it is good or bad. Now this is negative, adverse, but this is answer is positive, but still adverse. So don't go by plus minus also. Absolutely clear? Yeah, the same thing was repeated in the next question number 8, but there was no idle time. So without idle time, the calculation was done. Question number 9 was pretty interesting. Question number 9 was pretty interesting. But before I go for question number 9, I want to discuss one part with you. See guys, whenever there is information about days, you get calendar variance. And then you calculate for 25 days, supposed to work for something for in 27 days, how much? But when they say there is no variation in terms of days. Now that means when they don't give you days in the calculation, days are assumed to be the same. If your days are assumed to be the same, in 25 days you were supposed to work for 5000 hours. In 25 days, how much? You would have done the same thing, no? If your days are different, your answer will be different. If your days are same, then your answer will also be 5000. No? So whenever there is no information given about number of days, calendar variance won't be there, that is quite obvious. But even capacity variance will not have this calculation. You can directly go for budgeted hours minus actual hours. Because in 25 days, I was supposed to work for 5000 hours. Since it is 27, I could find out 5400. What if there is no change in number of days? This will also be 25, no? So in 25 days, 5000 hours. In 25 days, how much? It will be 5000 only, no? So budgeted hours minus actual hours into absorption rate per hour will give you the answer. We'll go for question number 9. Now when I talk about question number 9, let me tell you, your 1 per unit rate is 20 and your 1 hour cost you 4. Your each hour cost you 4 and you have incurred 20. Your each hour cost you 4 and you have incurred 20 for 1 unit. That means you must have taken 5 hours to complete that 1 unit. It is that simple. So my first 2 items in the data in the question suggest that each unit takes 5 hours to complete the production. Then I have budgeted production, budgeted output, actual output. My actual overheads are 2,95,000, 60 to 500 fixed, so that means the balance is variable. 74,000 actual hours. Now if I see this cost structure, I realize that 180 is going up to 210, 210 going up to 270. That means definitely it is not a fixed cost. When you calculate CPU, you realize that CPU is not constant. Had CPU been constant, I would have treated this as a variable cost. Had total been constant, I would have treated this as a fixed cost. But neither CPU is constant nor the total is constant. That means it is neither a variable cost nor it is a fixed cost. That means it is a semi-variable cost. And if it is a semi-variable cost, it needs to be split into 3 parts. Into 2 parts in 3 steps. So with the help of this formula, we could get the answer. With the help of this formula, we could get the answer. This is budget semi-variable cost getting split. We realize that variable cost per unit is 15. We realize that variable cost per unit is 15 and fixed cost is 60. Now guys, out of 20 per unit which is mentioned in the question, if 15 is going to be variable, balance 5 per unit was your fixed portion. It was quite simple. Out of 20 rupees per unit, if 15 per unit as per working note 1 is variable in nature, balance 5 per unit is your fixed cost structure. 1 unit takes 5 hours. So 20 per unit is an outcome of 5 hours. 15 per unit is also an outcome of 5 hours. That means your variable portion is 3 rupees per hour out of 4 rupees. That means your fixed overhead absorption rate per hour is a balancing figure of 1 rupee per hour. My working note 1 clearly tells me that my variable cost is 15 per unit. My variable cost clearly tells me my variable cost is my working note 1 clearly tells me that my variable cost is 15 per unit out of 20. If variable cost is 15, balance 5 per unit is fixed. 5 hours are required for each unit. So 20 per unit is an outcome of 5 hours. That means hourly rate is 4, which is any which way given in the question. So 15 is also an outcome of 5 hours. Variable cost per hour is 3. Variable cost per hour is 3, and 5 rupees per unit if it is your fixed overhead absorption rate, that is also incurred for 5 hours, so 1 rupee per hour. So these are the 3 working notes which you need to understand. Take a screenshot if you want, but this is how it should proceed. This is how it should go ahead. Okay. Then they asked me to calculate variable and fixed. So it was pretty simple here. For 1 unit, 5 hours were supposed to be worked for. 15,560 was given as actual output. 15,560 was given as actual output. How much should have been? Total number of hours? 77,800. 77,800 was your total standard hours. 3 was the rate as per working note 3. We calculated here, no, 3 rupees per unit. So that was the 3 rupees per hour that was applied here. And the rest everything was given in the question. This was a balancing figure from 295. From 295, if I subtract 62,500, which is a fixed cost, I'm left with 232,500 as variable cost. Then I calculated 3 variances based on this. Cost variance is pretty simple. Efficiency variance was asked, expenditure variance was asked, and then I went back to my fixed overhead calculation. For fixed overhead calculation, let me remind you, you need 8 items. Information about days was not given in the question. Information about days was not given in the question. That means there was no calendar variance required. 60,000 was my budgeted fixed overhead, which was found out in working note number 1. This was actual, it was given in the question. Standard budgeted output, actual output was also given in the question. 74,000 hours were also given in the question, and we already knew that 1 unit should be taking 5 hours. So 12,000 budgeted output should be taking 60,000 hours. I've got 5 per unit as an absorption rate, 1 per hour as the hourly absorption rate. 1 unit cost you 5. Okay, so efficiency variance. Now understand one thing, whether it is labor or variable overhead or fixed overhead efficiency variance, the bracket part remains same. I need standard hours for actual output for efficiency. Now see, I have standard hours for 15,560. So this is also standard hours for actual output only. So efficiency variance bracket part for labor, variable overhead and fixed overheads will always be the same. So you simply pick up the bracket part like this, 77,800 minus 74,000. But instead of multiplying by variable or labor rate, you applied fixed overhead absorption rate per hour. Your answer is done. And this part is also discussed when there is no information given about days. When there is no information given about days, there is not only calendar variance which is going to be skipped, but even calculation is not required. See, I am assuming that this was done for 30 days. If nothing is mentioned, this is also assumed to be done for 30 days. So in 30 days, I should have worked for 60,000 hours. In 30 days, how much? So basically your standard hours for actual days will also be the same, no? So simply you take 60,000 hours I thought of utilizing, 74,000 hours I have utilized, excess utilization of 14,000 hours, hourly rate is 1, 14,000 favorable is my variance. It was that simple. It was that simple. If you want, you can copy these solutions, guys. You can copy this solution of variable overhead first. I'll give you. Pause this video and copy this solution. Okay. Then you can copy this fixed overhead data and these two variances. This is what you have. Is this done? Yes, wonderful. So that was question number 9 for you. Question number 10 was also very simple. 3000 per unit was your fixed cost. 1500 per unit was your variable cost. Please concentrate very clearly. I'm not interested in this. Fixed cost per unit 3000. This is my absorption rate. This is my absorption rate. This is my variable cost per unit. Standard variable cost per unit. We had 11,50,000 as actual overhead figure. They did not give us the breakup of variable and fixed. They also did not tell us exactly how much is the budgeted quantity. So we assumed capacity to be the budgeted quantity. We actually produced 100. So my volume variance was negative, or rather volume variance was adverse. 200 units I thought of. 100 units I produced. So 100 units I couldn't produce. So I couldn't recover 3 lakhs. That was my volume variance in case of the next question, question number 10. But guys, for calculating expenditure variance, which was asked in the question, for expenditure variance, which was asked in the question, for expenditure variance, which was asked in the question, for expenditure variance, which was asked in the question, we couldn't go for variable and fixed separately because we did not have actual variable overheads and actual fixed overheads separately given. So we went for the combined calculation. We clubbed these two variances. See, variable overhead expenditure variance, variable overhead plus fixed overhead expenditure variance formula. Elaboration of the formula. आगे बढ़ते. Now this is your standard cost, guys. Standard rate into actual hours. I don't have hourly rate, I don't have actual hours, but I know one thing, the outcome of this is my standard variable cost. If I apply actual hours into standard rate, if I apply standard rate on actual hours, I will be getting standard cost of actual output, because actual hours has been the time for actual output. So standard hours into standard rate into actual hours will give you standard variable cost. This will give me budgeted variable or budgeted fixed cost. So basically actual variable overhead, actual fixed overhead I will not be having. So this will be clubbed like this, and finally I'll get the answer. If you find this simple, copy this. Pause this video and copy this if you find this simple. It is that easy. They did not give us breakup of variable and fixed. Okay, so we calculated a combined expenditure variance. Expenditure variance for variable, expenditure variance for fixed. We elaborated it further. We found out standard cost of variable overheads. We found out budgeted overheads in case of fixed cost. Budgeted and standard, fixed and variable, budgeted and standard were clubbed together. 7,50,000 was the total, and actual was clubbed together, and we already had the breakup. So this is what we needed in that question. Since we did not have the breakup of actual overheads, we calculated combined expenditure variance. So that was question number 10 for you guys. It was that simple. The next thing that I'm supposed to discuss with you all is about sales budget. Now sales budget, please remember one thing, your sales budget will be related to revenue. And since your sales budget is relevant to revenue, the whole scenario will be different. This time, if your actual is more than standard or budgeted, it will be considered as favorable because you are earning more. If your quantity sold is more than what you thought of, it's favorable because you're selling more than what you thought, you're earning more than what you thought. If selling price, actual selling price is lesser than budgeted or standard selling price, that means you're earning less, so it will be treated as favorable variance. See, that is a reason why I told you not to go for sign wise when it comes to determination of adverse favorable. You see the impact on profit, and that impact on profit will decide everything for you. Impact on profit will decide everything for you. Have you clearly understood this part? Yes. So sales budget, question number 11 I was talking about. Remember one thing, just like fixed overheads, even for sales budget, period should be the same. For material, for labor, for variable overheads, we were considering output level to be the same because all three were variable cost structures. But now we are dealing with sales, which is revenue, which has got nothing to do with the output anymore. So period should be the same. So if your actual period is 3 months and budgeted period is 1 month, convert that from 1 month to 3 months, bring it at par with actual, and then start comparing variances. Have you clearly understood this part? Yes. So question number 11 talks about your sales budget. We were supposed to calculate sales variances on the basis of the given information. We had information about budgeted quantity, actual quantity. We had information about budgeted selling price, actual selling price. So let me tell you guys one simple thing here. You have to first get it converted properly in a table. Get your total sales value of PQRS budgeted as well as actual. Get your total budgeted sales value, get your total actual sales value. Should start with the table like this. Be very clear about the data that you already have in the question. Please make sure that your data is perfect in front of you so that you will be comfortable in terms of getting these variances. So if you see this, you realize that instead of 5 lakhs, you earn 5 lakh 22. Instead of 5 lakhs, you earn 5 lakh 22,000. That means it is definitely a favorable variance for you, and that's your first variance, sales value variance. 22,000 favorable. Budgeted sales value minus actual sales value can be the formula. You know, formula is not material here. Formulas are not important here. Now, just like material, there are two reasons here. One is selling price and the second one is volume, the quantity. Selling price, if you see clearly, instead of 25, you could sell it at 30, favorable. Instead of 50, you could sell it at 45. You are earning less, adverse. Instead of 75, it is 70, adverse. Instead of 100, it is 105, favorable again. Calculated based on actual output, actual quantity, because unless you sell something, you cannot earn more or earn less. So actual quantity was always applied. So this is your price variance available with you, and then the volume variance. Volume variance also suggests you the same thing. Instead of 4,000, you managed to sell 4,800. Wow, favorable. Instead of 3,000, you sold only 2,800. Oh no, adverse. Instead of 2,000, it is 2,400. Wow, favorable. Instead of 1,000, it is only 800. No, this is adverse. So basically, you either sell more or you sell less. If you sell more, it is a favorable variance. If you sell less, it is an adverse variance. If you sell more, it is a favorable variance. If you sell less, it is an adverse variance. And since this is a responsibility of marketing manager, we cannot apply actual price here. He has no control over the price. So we have to go back to standard price structure, and 25, 50, 75 and 100 will be applied. So that was your volume variance. After volume variance, you go for mixed variance calculation as usual. Like 10,800 you were supposed to produce. 10,800 you were supposed to produce and sell. You thought of selling 10,800. That should have been in the ratio 4:3:2:1. That will give you revised mix. And finally, your total 10,000 units to be sold minus 10,800 actually sold multiplied by your weighted average standard price. Just like material yield variance, labor yield variance, here also you will be getting sales sub volume variance. Of course, we will not call it as yield. Yield is output. It reflects input output ratio. It has got nothing to do with sales. So we are not calling it as sales yield variance, it is sales sub-volume variance, or it can also be called as sales quantity variance. So that was your question number 11, guys. Question number 12 was a common question. It's an all-inclusive question. It was a revision of entire standard costing. Again, the data was given for 10 kgs packet. So either you can say that your standard data is given for 10 kgs, or you can say that your standard is given for one packet. Either you can say your standard is given for 10 kgs, or you can say your standard is given for one packet. That depends on the actual output. That depends on the actual output. How? If your actual output is in packets, I'll take one packet as a base. If your actual output in kgs, if your actual output is given in terms of kgs, 10 kgs as a base. One packet consists of 10 kgs. So if my output is given in packets, I will consider standard for one packet. And if the output is in terms of kgs, I will consider standard for 10 kgs as a base. We realize that the output was given in terms of kgs, 9,000 kgs. So if your output is given in terms of 9,000 kgs, guys, I'm going to consider standard data for 10 kgs. This is all given for one packet of 10 kgs. That means this entire data is available for 10 kgs. That means this entire data is available for 10 kgs. This entire data is available for 10 kgs. So I'll consider standard for 10 kgs as a base. I will convert it and take it to the level of 9,000, and that can be done this way. See, look at the table now. 10 kgs of finished product requires 10 kgs of raw material. So 9,000 will require 9,000. 9,000 will require 9,000. Eight hours are required for 10 kgs. For 9,000 you would require 7,200. It's going to be the same. And finally, the pricing was also made available in the question. Actual data was also available in the question, and we were just supposed to calculate variances. The only important point in this question was selecting the right standard. If my output was in packets, I would have done the same thing, but I would have taken standard given for one packet. 9,000 packets multiplied by 10 kgs, 90,000 I would have taken as consumption. Had 9,000 been packets. But it was 9,000 kgs, so the base was kgs. Understand, one packet consists of 10 kgs, so standard is assumed to be for 10 kgs. Pretty simple calculation. For fixed overheads, of course, you can gather the information from the question, as I told you. So this is material labor variances are quite simple to calculate. Variable overhead variances are like labor only. But always remember one thing, if there is no information given about actual variable overhead hours, we have to assume actual labor hours to be the base. In no situation consider standard as a base. Some great people do that in the class. It is horrible. If you are working for 10 hours, electricity is also getting consumed for 10 hours, so variable overhead will also be taken for 10 hours. How can you assume that standard and actual are same? I hope you are understanding this. So if nothing is mentioned, about variable overhead hours, For standard, I will take standard labor hours. For actual, I will take actual labor hours as a base. Is this part absolutely clear? What if you have idle time given in the question? What if you have idle time given in the question? Suppose in 7,000 you had 200 idle time. I would have taken 7,000 here because labor doesn't get affected because idle time is also paid for. But variable overheads, when you write, I would have taken here 6,800 had there been idle time of 200. Had there been idle time of 200, I would have taken this as 6,800 because idle time is unproductive. And if it is unproductive, there is no production, and there is no production, there is no quantity, how can there be a variable cost, guys? I hope you are understanding what I am saying. So, as far as variable overhead hours are concerned, labor hours will be the base. If standard variable overhead hours are missing, you can take standard labor hours as a base. If actual variable overhead hours are missing, you can take actual labor hours as a base. But for God's sake, please don't assume that standard is same. Please don't assume that. Idle time, if you have, don't separate idle time in case of labor table. We separate idle time after time variance before you get efficiency variance calculated. As far as variable overheads are concerned, your idle time will be separated right from the beginning. In the table itself, you will be subtracting idle time. In the table itself, you will be subtracting idle time and you will be writing net hours in the calculation. So that was your question number 11, and the rest was variance calculation, which was pretty simple. There is nothing to be discussed about it. So guys, this was your standard costing. Basically, please be very clear about one thing. Variance calculation, you should know. I mean, that is quite obvious. But then you should understand one thing. For material, labor and variable overheads, your standard data must be at par with actual data. So, revise your standard from given level to the level of actual output. That is one thing. Secondly, your fixed overhead variances and sales variances, they are based on time. So actual period should be the same. We have got nothing to do with output. So if your actual period is 3 months, your standard or budget must be revised from whatever level it is to 3 months. And then only you will be able to calculate variances. So that's it, guys. That was everything about standard costing. So we discussed everything, and to the core, even idle time part, something which is not given in the question is also discussed here, guys. So there was no idle time given here, but still I discussed that because I wanted you to know the concept. Labor hours inclusive of idle time, variable overhead hours excluding idle time. Thank you so much for watching this video, guys. All the best. I'm sure you're going to rock in the exam. Thank you so much.